Yo, how's it going, guys and girls? My name's Chris, and welcome to my channel, CSM Investing. If you're new to investing, or even if you're not and you've been in the game a while, it can sometimes be a little bit hard to know what you're looking for. Obviously, with time, it becomes like second nature. Go here to see what their earnings are. Go there, see what they're doing with their money. So on and so forth. But in this video, we're going to be talking about what you need to know about every stock and what you need to look for. You have to understand the importance of what we're about to go through. If you don't know what we are about to go through, then you shouldn't really be investing. Yes, at the beginning, it's okay to dabble in a few stocks without knowing absolutely everything about them. But what we're going to be discussing is the bare minimum of what you should know. So if you don't, and after this video you actually learn something, you may want to re-evaluate some of the positions that you have, because you may be in danger of losing money. We all get it. At first it seems just so easy just to put your money in certain investments and think, oh, they'll be fine. But yes, in some circumstances you may get lucky, but it's genuinely not sustainable. Look, you might not have this massive team behind your back like these big corporations do, where they do all the research for you. But it does only take a few minutes just to check up on what the companies that you're involved in are doing, whether that be on Yahoo Finance or just Googling, because there's bound to be news out there. It takes minutes. And it's vital that you do this, because instead of raking in money, you'll be raking in losses. And that's not the news that we want. Don't worry, it's not all doom and gloom. It is okay. Yes, you may need to do a lot of research, but with the simple suggestions that I'm going to give you, it's going to make it a lot easier and a lot less time consuming. So breathe and relax. While we're here, make sure to like, subscribe, and hit that notification bell. Right, let's get straight into the video. One of the key things that you need to be doing while investing is as simple as this: knowing what a company does.
Well now, Chris, what do you think I am? An idiot? Knowing what a company does? You stupid. Of course you need to know that.
Well, to be honest, I understand that it's very simple. It's a simple task to do. But some people who invest don't actually know what the companies are that they invest in. And I don't mean such things like, Tesla, they make electric cars. What I mean is, what do they manufacture? Whether they offer any services? What countries do they operate in? Are they the leader within their field? And what is their flagship product? And how's it selling? Put it this way, if Jim Cramer in his book Real Money suggests for investors not to invest in a stock unless they have comprehensive knowledge of what that company that they're invested in actually does, then I'm sure we should all just listen. Here's a bit of a weird example for you, but it works. Would you ask someone to marry you without knowing them first? If so, good luck to you. But for me, myself, it just wouldn't work. So, that's the simplest way of me describing it. If you're willing to throw yourself into the deep end and actually marry someone who you don't know, I'm pretty sure that in most circumstances, it's not going to work out. And that's how you should pitch your stocks. You should get to know them first and then take that leap if you're willing to. Just remember, even if you do your research on some stocks, they might not always pan out. That could be because the CEO wasn't the right man for the job, or maybe even the company was doing something dodgy on the side. Now, that's the equivalent of meeting someone, dating them, getting to know them, and then all of a sudden they're cheating on you. Now, no one likes it, but there's a slight chance that it might happen. You've just got to take that risk. Now, it's as simple as this, and I know I keep using the word simple. It's probably one of my favourite words because I like to make things easy. But it is as simple as this. If you want to find out what a company does, go onto Google and type in the company name. And then once you've found this information, try and keep it in your head, and to remember it, go tell someone about the company. And then once they ask questions and you're able to actually answer those questions, you should know enough about the company. I'm going to make this point as quick as possible. In order for you to spot a good investment, look at the PE ratio. PE is price to earnings. You can calculate this by dividing a company's market value per share by its earnings per share. This is useful to know because then with this ratio you can find out what the current share price is of that company relative to its per share earnings. Then from this you're able to compare the company that you're looking at to its competitors and then determine its relative value. Usually stocks with a PE ratio of below 15 is to be thought of as cheap. And then a stock with a PE ratio of 18 is to be thought of as expensive. Generally speaking, a higher PE ratio indicates that investors expect higher earnings. However, a high PE ratio isn't an indication of an investment being a good one, whether that's against a lower PE ratio, because sometimes a high PE ratio can show that a company is being overvalued. An example would be if a company's PE ratio is 20. This means you will pay $20 for every $1 per earnings. Yes, this does seem quite expensive, but not if the company is growing quickly. Some people find this next step a little bit difficult to understand, so I'm going to break it down in a way that makes it easier for everyone. So the next step is understanding the beta. Now this just means how volatile your stock has been in the last 5 years. So to put it simply, it measures the stock's risk against the entire market. And you can literally do this by just typing in Google the company and then finding all this information out. In the stock market, what do we look at as being the most stabilised system? Well, the S&P 500, of course. So the way that this beta works is if it drops below or rises above the index over a 5-year period, it has a higher beta. In order for the beta to be higher risk, it has to be above 1. And anything below 1, that tends to be lower risk. With lower beta stocks, you won't make as much money, but whatever you do make, it's made in a lot safer way. Whereas with higher beta stocks, yes, you might make a lot more money, but it's a lot riskier and it could all go in the opposite direction and you end up losing everything. So make your choice wisely. The next step is to look at whether the company that you're invested in pays out dividends. Now, not everyone has all day, every day to be looking at stocks, whether they're going up, whether they're going down, day trading, it can be a bit of a hassle. So looking at whether a company pays out dividends is quite important really, because dividends act as interest in a savings account. And even if the stock price goes up or down, you're going to get paid. Now, some investors can make a substantial living through dividends, but you have to put in enough money for it to be worth it. Now, in my opinion, as a growth investor, if a company does pay out dividends, I suggest reinvesting that money back into the company. That way you're able to take on what's called compounding. So your money makes money, making money, and it just grows over time. Look, I'm not going to mess around with you, but the best dividends are usually paid out by the bigger corporations. This is because they usually have predictable profits. Now, the sectors that usually pay out the best dividends are like oil and gas, banks and finance, utilities, pharmaceuticals, all them different sectors. Now, me personally, I invest in like future stocks, so I like EVs, I like energy sectors, all that sort of stuff. So technically I don't invest in any of these, but if you're looking for an easy way to make money, go for this. And look, dividends up to 6% are not unheard of in high quality stocks, so go for it. The reason that I say that for dividends to pay out good, you're going to have to invest in like the bigger corporations, is because if a company's just starting up, they might not have the profitability to actually afford to give out dividends. They usually invest it back into the company first to grow that company. But look, even though I don't do it, I do suggest if you're looking to just store your money in the market, I just suggest finding a company that pays high dividends. My last suggestion is to look at a company's chart. Now, this doesn't have to be as hard as it actually looks, as yes, if you are looking at the candlesticks, the line and the bar charts like the fundamental and technical analysts do, it can be difficult. But it doesn't have to be that way. All you need to look at is whether the graph starts in the bottom left and starts making its way on an increase to the top right, or if it's from the top left to the bottom right. Yeah, makes sense. And if that is the case, then I suggest not even touching that company with a goddamn barge pole. Now, that is unless you've done your research and you know with near certainty that in the future it's going to be on the rise. So that's weighing out the risks there again. My final thoughts here are that if you're wanting to become an investor, I suggest following these steps. Look, I'm not the brightest lad in the world, I never really have been, but if I know to do this, then you should too. It's not hard. At first it might seem a little bit complicated, but once you keep learning and you keep doing it, you'll smash it, I promise you. I'm Chris, and thanks for coming to my channel. Peace. My last suggestion is that... God's sake. My last suggestion is... Why can't I say suggestion? God. Risks.